Hey, Mike, what's the stock market going to do next?
I don't know.
This is the end, therefore, of Financial Success Podcast with certified financial planner Mike Morton. I'm your host, Matt Robeson, and unlike other shows that make you feel overwhelmed, we tell you the simple steps to be successful. And today is super simple because Mike's given the game away. We don't know. And while we could end the episode right there, we won't. We're going to explain more of why we don't know, or maybe the little bit that we do know, right?
Yeah, we're gonna talk for like half an hour about all the things we don't know. It'll only fill half an hour, Matt.
How is that different than anything else that we do on this show or in our lives? And speaking of, boy, this is a deep, deep joke for our Jewish listeners. Speaking of Manish Tana Halayla Hazeh, which means why is this night different from all other nights? Hang on for our one thing segment at the end, where I'm going to call for an end to the war on Christmas and the beginning of the war on Hanukkah. And before we get to that, we're going to hit one of our listener questions, which is part of a new listener question segment that we're really having fun with. And you're going to want to hear what that is all about. But Mike, joking aside, or joking included,
Wait.
what is the... I gave you too much to chew on. You can't get to the stock market yet.
It was too much. Wait. I love that in this episode, we're ending a war.
And beginning another war. So,
I forgot the beginning of the war.
Net, no
war.
Change in war status.
In war status.
Right.
Okay, same war status.
Oh my gosh.
Okay.
Yes, good. The war on Christmas. It's terrible. Did you see Weird Al Yankovic's brilliant meme tweet a few years ago? Where you remember how, as part of the supposed war on Christmas, there was criticism that the goddess figure that appears on Starbucks cups was a pagan figure, and that was part of the war on Christmas. So Weird Al Yankovic photoshopped it to a horned devil figure that said, "Hail Satan." And he tweeted it out and he said, "All right, Starbucks, you've gone too far."
I mean, just a little bit.
All right. Speaking of going too far, is it going too far to say that we know nothing about what the stock market's going to do next?
We know, Matt, you and I know all kinds of things. So
but we're not going to tell you? Boy, that's
We're just not going to tell you. We're going to keep it to ourselves. We know all kinds of things about the stock market, except what it's going to do next. So... yeah, the thing is that value right now, you may have heard, valuations are pretty high. And so it's a topic like, hey, given that, or, is that true? And what does that mean? And so I thought it's a good, the end of the year, it's a good time to kind of wrap up on that and see if there's anything that you can do or anything that we do know.
Got it. So what you're saying is, like the late, great Yogi Berra said, it's hard to make predictions, especially about the future. But we have some indications here that, I mean, at least the experts who are paid to know something are telling us that they're seeing signs that it's not going to be so sweet in the stock market.
Yeah, that's right. So both, this was from a Wall Street Journal article, caught my attention. So there's some quotes from that. And some of this information kind of comes from that Wall Street Journal article. I'll list that in the show notes. But Goldman Sachs thinks the S&P 500 will make just 3% a year over the next 10 years. Okay, so 3% a year over 10 years. That's pretty paltry when you think about the last 100 years. Stock market generally might say makes 9, 10, 11% a year. They're saying 3% a year. And Bank of America expects 0 or 1% a year for a decade.
Wow, that is disquieting. Did I mention that the next decade is when my children are going to college? Yours too.
That's a whole other episode.
Oh,
that's the episode where we're drinking, Matt.
Yeah, that's not so great. So I suppose I should just stop investing in stocks and head over to the bond market.
Yeah, no, you should just keep buying stocks. So both Goldman and Sachs, and other places are saying like, but still just buy stocks anyway.
So why?
What's up with that?
Why? Yeah, I mean, I think I know, but I'm more likely to be wrong than right. So what they're saying is returns they project are going to be below historic averages, but plow on ahead anyway. I mean, Is this like when your orthodontist is like, yeah, your teeth are fine, so I think I recommend braces?
That's right. Yeah, and both. The reason is the timing aspect. So like, even though both those organizations and others have said like, geez, the next decade might not look that great. And we're going to get into why they're saying that. At the same time, next year might be awesome. There's no correlation between the current valuation and the next 12-month return. Okay.
I see.
So that's the thing. Like over the next decade, sure, we might have some correlation between kind of where we are and the decade of returns, but you have no idea about 2025's return.
I see. So what you're saying is that in terms of the why they think it's going to be perhaps not as robust a return over the next 10 years as we've seen before, is that you said the word overvalued. Is that the culprit?
Let's break down why they're saying that the next 10 years don't look that great. So we've quoted this before. Robert Shiller, Nobel laureate, has put together some great research quite a while ago, and that's called the CAPE ratio, which is the earnings return. And that graph, which we'll again link in the show notes, is almost at an historic high. The only time it was higher was at the dot-com bubble, right before the burst of that bubble. Okay, so this is the ratio of earnings and to price to earnings. The price of the stock market to the earnings of all the companies. All right, and that gives you a value. So how much are you paying? Think of it like, how much am I paying to own this thing? And as the price goes up, you're paying more to own the same thing. Right? So you might have, right now we're paying more to own the whole stock market. You're paying more than you've ever paid, except right before the dot-com bubble. All right. So that's why valuations are high. The stock market's high. You're paying the most. It's like the price of bananas, $3 a banana. It's the most you have ever paid for this thing.
And so what Goldman Sachs is saying is this isn't sustainable.
Yes. So when you look at there is a correlation between the next 10-year return. And so again, Shiller's done this work as have others. Take the following 10 years, look at that, wherever the ratio is historically, this price to earnings ratio, and then measure the next 10-year return. And there is a correlation to that. The higher the price that you pay, the lower the return over the next 10 years. And conversely, the lower the price that you pay, during some times, the lower the price, the higher the return over the following 10 years.
So I want to eventually get back to, the ultimate landing point, the ultimate advice here, which is he's still basically doing the same thing. But is this the kind of thing that could change? Like, so for example, what you're saying is that the underlying value of the stocks is not that high compared to how much we're paying. And so, but is it possible that as technology changes, as the economy shifts, we could go through a rapid growth phase? We could have new innovation that makes companies more valuable, that increases profits. Is it possible that 10-year projection, if you're doing it in 2027, could suddenly look much better than it looks now?
Yeah, it's definitely possible. So that's one of the things that people will talk about. So again, we have a ratio, which means numerator and denominator, a fraction. On the top is the price you pay. On the bottom is the earnings of the company. And that's what you're alluding to. It's like, these companies are going to make more money in the future. So if they make more money, it makes the ratio smaller and the next 10 years look better. Right? So yes, that is possible, and it's happened in the past. The problem is you're relying on quite a lot. Earnings should be robust next year. That's one of the reasons why next year might still keep going up, because earnings are looking pretty good right now. But they have to grow tremendously. There's two problems. One, they have to grow quite a lot to grow out of this problem without the price changing. And the other is what's been driving the earnings is only a small number of companies. In the first half of 2024, it was really that magnificent seven, these massive companies, NVIDIA, Microsoft, Amazon, Alphabet, that were driving a lot of the stock market return, and their earnings were doing well, but a very small segment. Many stocks were very flat all year. Earnings were not increasing robustly. And that's kind of a problem when you have these, and again, this happened back in the dot-com bubble, where just a few companies were really driving the market returns. And then you don't have this kind of overall economic build. It's just kind of this little bit more of, a smaller number of companies are driving a lot of this, and it is not as sustainable.
So a very simple strategy one might adopt with everything you just said is you might say, well, maybe what I should do is no longer hold a portfolio of the whole stock market, right? I shouldn't have an index fund. I should just invest in the Magnificent Seven. Those are the ones that are earning the big returns. Why is that wrong?
Well, no, that's a great idea. You should have done that 2 years ago. It'd be awesome.
Right, because I don't have a time machine.
Yeah.
Right.
So that would have been a great idea, but is it still a great idea?
Yeah.
Probably not.
Past performance is no guarantee of future results.
Yeah.
And I suppose what you're also suggesting here is that there's got to be a correction at some point here to the fact that this price to earnings ratio has gotten out of whack. And one way to do that would be for the price to go way down, i.e. for the market to go way down. But I think I think most listeners to the show know that maybe the worst trap you can fall into is trying to time things. So I imagine that another strategy you could adopt is also not a good one, which is say, well, maybe I'll just get out of the stock market right now, assume that the correction will happen sometime in the next year or two, then jump back in and I'm good.
Yeah. Highly recommend not doing that. And the biggest problem is you will not jump back in. And you won't know when to jump back in. That's the problem with that strategy is, yeah, it's not a bad idea to like cash out while things are high. It's like, oh, I should, sell when it's high, right? Sell high. So that's like today, it's high right now. I should sell. The problem is it might not ever reach this level again. 2025, it might go up 15% and then drop 20%, but that's still back to today's value. Right? So when do you get back? When do you take all that cash that you put on the sideline and get back in? Emotionally, you'll never be able to do that.
Or what do you do with it in the meantime? So you take the cash that you got and you reinvest it in bonds or gold or REITs or something. And, you've got some alternative return, which is good, but that might do worse. You might time it totally wrong. You might miss out on a robust year in 2025. So, not the greatest step. So what it all boils down to is what you said at the top, which is you kind of have to grab the wolf by the ears and hang on for the ride and just stay in the stock market.
Well, I do have an alternative for you.
Well, sorry, I should have qualified that. The only good alternative, is it a good alternative? There's lots of alternatives.
There's lots of alternatives.
Yeah.
I actually do think a couple things to look at now. How to use this information. Well, you can be active a little bit, be proactive to make yourself feel better. We know that like doing something and not doing nothing can sometimes feel better. Like you get a little antsy just sitting on your hands. So here's something you could do. One, look at your overall portfolio and see how much is in the stock market. Okay, so just take a look. Are you, 70% stocks, 80% stocks, 95% stocks? Kind of where are you? And is that where you want to be? Okay, is that a good long-term, like, hey, Matt and I, maybe we're still working for quite a while, even though we do have kids going to college. And so we might be 80, 90% stocks. It's kind of where be pretty aggressive. What I would suggest, I would do that as step one. Just know where you are and make sure that's right for you. We've said that a number of times. The other thing you could consider is twisting that dial a little bit and being slightly more defensive. So if you're typically 80% stock person, that's good. Like that's your target date fund, you're adding money to every time. You could switch to a target date that's slightly different that goes 75% stocks, 70% stocks. You can tweak it by 5 or 10%. Make yourself feel good. If it does go down, great. We can twist the dial the other way. If it doesn't, you're still 70% stocks. You're still in the game and you want to stay in the game. So definitely don't do the cash option like Matt was just saying. Not recommending, just contemplating. But you could tweak your overall allocation to just feel a little bit defensive given, the valuations of where we are.
All right. So don't abandon, maybe tweak.
Yeah. Yeah.
All right. Well, that gets us to our listener question. And I want to say as a public service announcement, if you are listening to this and you're a current client of Mike's, you get a little added benefit of that status. You can simply email him your question and you'll get a custom response just for you. But if you would like to hear future professional thoughts from Mike on a question you have on a financial topic or random thoughts from me, you can email the show. That's at realfinancialplanning@gmail.com. Looking forward to lots more listener questions. For this week, the listener question is, I expect to spend $100,000 on a home renovation next year. How do I factor that into my investment portfolio? Dang it, Mike, I wish I'd heard the answer to this question before I did a home renovation 6 years ago. So no time machines, but I'm really looking forward to the answer on this.
Well, it's great. You've spent the money on your home and hopefully you're enjoying the fruits of that expense.
We're enjoying it, but several of the subcontractors did shoddy work. I'm not naming them, so no defamation suits here, but my goodness, within 6 months, our cabinets in the kitchen literally fell apart, like literally standing there and panels falling on the ground. Something is wrong here. It was like living in the Amityville horror house. It's like, hey, honey, I'm really enjoying cooking dinner. Get out. Too bad the cabinets are falling apart.
Yeah. Time to go.
Yeah, fantastic. So I'm otherwise enjoying it very much, and I feel very privileged to be able to renovate the kitchen.
Well, that's just a benefit. You don't have to actually open the cabinet to get out your ice cream bowl.
That's exactly right. Yeah. Why didn't I think of this before?
Well, I have doors on cabinets.
You know what I tell all of our house guests, which are not many because we're embarrassed about the look of our cabinet. I'm like, you know what? We have very, very high-end exclusive cabinets. They're invisible panels. And they actually have that force field Star Trek technology where you can reach right through them. You don't see that it's even there, but it is. Believe me.
That's awesome.
All right. So for our listener who's looking forward to spending $100,000, but hopefully not on the same subcontractors that I used,
right.
How should they factor that into their investment portfolio?
So yeah, when you think about in portfolios, so you've got money in your checking and savings accounts and brokerage accounts where you might have some investments, and then you got your 401ks and your IRAs as well. So that's kind of the overall investment portfolio. If we're going to spend money in the next 6 to 12 months, I would set that aside as cash. You can put it in a money market fund or a CD, get 4 or 5% interest on that 100,000. Set it aside and, make sure you don't lose any of it. So keep it in a money market, keep it in a CD, get 4 or 5% interest. That's where we are today. So definitely, get that interest while you're finding your subcontractors, not Matt's. And then the rest of your portfolio, we were just talking about portfolios. Hey, what if you're 80% stocks? I would set aside this 100,000 from that calculation. All right. So it's kind of in your everyday checking account. We're spending it next year. Put the 100,000 aside, total up everything else, brokerage accounts, 401ks, and rebalance that. And so in other words, okay, could be like, oh, we're 80% stocks, but if I take the 100,000 I'm going to spend, now we're 86%, in the stocks, right? Because I'm taking out 100 grand. Well, then you got to sell some stocks somewhere, to get back to that 80%.
Rebalance,
right? So that's how you really, and now's a good time for doing this kind of thing. Again, stock market's done well the last 2 years, more than 20% a year for the last couple of years. So hopefully you have some gains. So go ahead and sell those, set aside the 100 grand so you have it ready to go for those renovations, and don't include it with the rest of your portfolio.
I see what you did there. You linked that together with the first part of the discussion, right? It's like now is a good time if you're going to do that and you're thinking about a rebalance or a more defensive position anyway. This also goes hand in hand with what we discussed on the last show, which is some people might be considering end of year Roth conversions, or they might be in my situation where there's too much in their brokerage account and you've got to do that backdoor legal, Legal, legal money laundering scheme where you basically take money out of that status and put it into a tax preferred account. Now's a great time to do that because you've probably experienced some gains. Yes, you'll take a little bit of a tax hit, but if you can get it into one of those better tax accounts, IRA, Roth IRA, you're going to make it up on the back end over time. So, awesome.
You got it.
All right, man. All right, look, let's get to our one thing. I know it's off topic. This is not LinkedIn, really. It's really not. But it's kind of a fun one.
Right.
And it's appropriate for this particular year and this time of year because this year there's a magical confluence. For the first time since I can remember, I'm sure this is a Googleable thing, Christmas Day and Hanukkah, the first night of Hanukkah.
Oh, that's right.
Are on the same day. And last I checked, that's December 25th. And that creates an opportunity to consider the pairing of Christmas and Hanukkah. And I am a Jewish dude. And I also write a weekly column for Newsweek. And I am in the midst of writing my most recent column, which basically says, Jews like me, we strategically messed up our entire approach to Hanukkah decades ago. Let's fix it. What we did, essentially, quick backstory here is that for our non-Jewish friends, you may not be aware that Hanukkah is not actually a particularly significant holiday for Jews. It's not really in the Torah. It's not really something that was practiced for the 5,800 years of recorded history that we have in Judaism. It's essentially an invention of American Jews over the last 100 years or so, who both, a lot of them were first generation Americans and they wanted to be included in the American enterprise, which is largely kind of commercialized Christmas. And the other thing they wanted is to keep up for their children's sake with the Christmas industrial complex of present giving and Santa Claus and all that. And where we eventually landed was Adam Sandler and the Hanukkah song and 8 Crazy Nights and the needing to keep up. Except here's my pitch to all of my fellow Jews. We are trying to compete in the marketplace against an established incumbent with overwhelming strength and status, and we will never do it. We have an inferior product. It's poorly marketed. We give little tchotchkes and uneatable chocolate for 8 days to try to compete with Santa and the mega present giving. And it's not working. So don't do it. Don't fight a Goliath strategy. Fight a David strategy. And, that's very in keeping with our people. Like, just stop giving Hanukkah gifts. Don't give Hanukkah presents. Instead, do something that's fun and associated with Hanukkah and let your Jew flag fly. Eat donuts. Like that's something that you're supposed to do. No, seriously, you're supposed to eat anything that's soaked in oil. Eat something delicious from your local Chinese place. Here's another great Jewish tradition: eating Chinese food on Christmas because it's the only type of restaurant that's usually open. So get some delicious and oily Chinese food.
You know what I don't get, Matt. I don't get how you guys mess this up.
You don't get
I don't get Judaism. I don't get how you guys mess this up. Christmas is like 1 day of gifts. You got like 8 days of gifts. How are you not like 8 times bigger?
You know what the thing is? There was an SNL skit about this. It was like a song and it featured Emma Stone a few years ago. And it was like, the joke was, if you're going to give a candle as a Christmas present, which is like a shoddy present, right? The biggest mistake is don't give another little thing in the bag because it makes the first present look smaller than just one thing. This is what we did. We basically turned our gift into a Horcrux. We divided it into 8 parts.
It's 8 parts.
Right?
Yeah.
And,
right. That's true.
And each one is small and shoddy. And it's silly.
Right.
It's silly. We're not going to keep up. So don't compete. David strategy, people.
I can't believe the Horcrux. I can't believe that's what it is. 8, you divided into 8 parts, so you're just comparing Hanukkah
aside
to
from
Horcruxes.
The evil of the metaphor, I think it stands up pretty well. Listen,
pretty well.
Again, I think I think Hanukkah has, I mean, we have dreidel is awful.
Dreidel. Come
It's
on,
essentially, but by the way, before people get too precious about like, I'm calling for, let's do fun new things, like create a fun, like first person game or app that has to do with Hanukkah. It's like before people are like, no, that dreidel is basically straight up gambling for children. Okay. So don't tut me, my friends. All right. Let's do fun, original, creative stuff that's awesome and that's not like Christmas. Let's just do our own thing. Ban Hanukkah presents.
Okay. Out of the industrial complex.
The industrial complex. All right. On that note, that probably appealed to about 1% to 2% statistically of our audience. I'm Matt Robeson for Mike Morton. We will see you next time.
Thanks, Matt. Thanks for joining us on Financial Life Planning. If you like what you heard, please subscribe to and rate the podcast on Apple iTunes or Spotify or wherever you get your podcasts. It makes a massive difference. If you have a comment or question, please email me, mike@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.